RIMS as well for hosting me today. I've had the pleasure of speaking at RIMS before in Auckland and also at the global conference, I think it was last year in Boston, which was amazing. It was absolutely enormous. So yeah, fantastic event and one in which I can thoroughly encourage people to go to if you ever get an opportunity. So I'm going to share my screen now and jump straight into it. Oh, okay. Lana, we have our first technical issue. The host has disabled participant screen sharing. So I need you to re-enable it if possible, which we should have trialed there before. So where are we? Let's have a look. I need to...
I think there we go.
Okay, let's try that again. We share screen. Technical problem solved. All right, we're back in business. Okay, so hopefully everybody can see my screen. Lana, can you see that? Just so
no, I can't.
Okay, all right, we'll try that again then. All right, that one, and we're gonna share. Okay, should be able to this time.
Yeah, it's loading now. Thanks, Paul.
Okay, cool, thank you. Okay, so let's jump into it. The topic for today is going to be really simple. I'm going to talk about, first of all, I'm going to introduce this general concept of intangible assets because the digital assets are a subset of intangible assets, and it's important we understand where they fit relative to other asset types. And then I'm going to focus a little bit of time around how these assets can create value, because let's face it, if they couldn't create value, we might not necessarily be all that interested in them from a risk perspective, right? So we want to understand how they can create value, but we also want to understand the risk component of that as well, and that's what I'm really going to end on at the finish. As Alana mentioned, EverEdge is an intangible asset specialist. We've been around about 12 years now. We've done roughly 1,000 client engagements. Those who are familiar with NPS, Net Promoter Score, as a benchmark, as a metric, where ours is plus 63%. Anything over 50% is considered outstanding. And the benchmark for our industry is about minus 22. Management consultants really do steal your watch to tell you the time. And our return on client fees is typically very strong, generally in excess of 10x. If a client gives us $1, we're generally able to give them at least $10 value back. Clients include, in New Zealand, for example, most of the major corporates, etc. Offshore, we work with, for example, in Singapore, Singtel, Singpost, Singpower, SD Aerospace, SD Kinetics, three of the big three banks up there, etc. So what we do, and this is kind of relevant to what I'm going to talk about today, is very simple. Number one, we say, what are your intangible assets? And that's often the first time that anybody has asked the company or the client that actual question, to actually drill down and understand what those assets are. Secondly, we then say, well, what are the risks of those assets? And obviously, this is a topic that I think a lot of people are going to be wanting to talk about today, and we're going to focus, but a lot of companies don't understand the risks around these assets at all. The third thing is that we then say, what are those assets worth? And by understanding what those assets are worth and putting a price tag on them, we're then able to unlock value in them. And I'm going to give some examples of that as we go through. So jumping straight into it. So the most valuable assets aren't on the balance sheet. It would seem a bit odd, but it's true, right? If we go back, what you see on this chart here, this is the S&P 500 over the last 40 years, split between tangible and intangible assets. And as we can see, intangibles have grown from roughly 17% of all company value in 1975 to roughly 87% of all company value today. What is very interesting about this figure is that if you strip out the real estate holdings of the S&P 500, that figure climbs up to about 96%. If we look at the top 5 companies by market cap, it climbs to about 99%. Right? So basically, all value is in these intangible assets today. And those intangible assets are everywhere through our company organization, through our company. So they're not just in the traditional things that people might think of, such as say, patents or trademarks, but in a whole host of different assets. So things like confidential information, systems and processes, regulatory approvals, software code, data, obviously, internet assets, regular, and networks and relationships. And what's also interesting about these assets, so not only are they everywhere, but they are now, in fact, outside of pure real estate plays, they are the primary drivers of virtually all company performance and earnings growth. In other words, companies today, this is where your profit comes from, is fundamentally from these assets. And what we know about, and there's a very simple thought experiment we can actually do to prove this. So imagine a very fixed asset, tangible asset intensive industry, let's say a steel mill. And let's bring that I give you a steel mill. I said, here you go, have a free steel mill. But the catch is you don't get to keep any of the intangible assets. So you don't get to keep any of the software that runs the mill. You don't get to keep any of the industrial know-how. You don't get to keep the customer or supplier relationships. You don't get to keep the regulatory approval. You don't get to keep the brand, for example. What becomes very relevant, very obvious very quickly, is that the value of the, regardless of what it says on the balance sheet, the mill itself is not an asset or it's a liability. The real value in that mill is the ability to run it safely and efficiently. And you cannot earn even a single dollar of earnings growth from that mill without those intangible assets. And all those assets are intangible. And that's the key point, is that the intangible that actually generates earnings growth today. And so what we find is that most businesses today have valuable intangible assets. If we went out to South Auckland and we picked up a random small manufacturer, what you'd find is that they would say, we don't have intangibles, but in fact they have intangibles right throughout their entire value chain and value stack. If we then start to talk about a tech company or even a finance company, etc., then they're entirely intangible. That's all they are. Right? They're entirely intangible. But the big irony is most companies are looking the wrong way, right? This is a fake photo, right? This is actually a real photo. Most companies are looking in the wrong direction. They're focused and concentrating on their fixed assets or their tangible assets, right? So and this is also true of most banks, most investors, most lawyers and accountants, etc., still tend to focus on fixed assets. So you find there's an awful lot of running around, tracking of chairs and laptops and plant and equipment. And actually a real failure to recognize that this gap is opened up between, on the one hand, what company accounts say, and on the other, the reality of value and growth and risk within the business, right? And the fundamental reason for this distinction between these intangible assets that are very valuable but don't make the balance sheet is really to do with the accounting of intangibles, right? Because the accounting standards were basically designed for this era, right? In which we had things were really all about fixed assets and plant and equipment and inventory and so forth, right? It was a very tangible asset age. And the standards for dealing with intangibles have never really moved on. So if we look at how accounting standards treat intangibles, and this will be very relevant as we move through, is that they're either completely off balance sheet. So they simply don't make the balance sheet at all. Or they go under goodwill, and the issue with goodwill is really that part of the business we paid for, but we don't know why we did, so we have to call it something. We call it goodwill, right? Or they go on cost, and the issue with cost is there's no correlation between cost and value with intangible assets. That is very different than with physical assets. So the desk that I'm sitting at, there's a definitive correlation between the input that went into it, namely the plastic and the metal and so forth, and its value. As much as I'd like it to be, it is never going to be worth $1 billion, right? But with intangible assets, there is no correlation, right? You can have invested very small money in something and it become worth a huge amount, or you can invest in a fortune and it won't be worth anything at all. So that's really problematic when we consider that the fundamental basis of accounting is cost-based accounting. Okay, and so what this means in essence is that the way that intangibles end up showing up inside company accounts is really quite distorted. And as this gentleman said very famously, accounting is the language of business. And as anybody who's read 1984 will tell you, that language is really important in defining how people think. So if accounting is the language of business, it defines how we think about business. And it also therefore defines how we think about risk, which is the point I want to make here. Because accounting standards drive company reporting, the way that companies think about themselves, the way that they record their transactions and their performance. And company reporting in turn drives three other things. It drives capital flows. So how investors and capital providers look at and evaluate a business. It drives the regulatory framework, the way that the regulators and government institutions think about and regulate business. and it drives management behavior, the way that management thinks about the business and its performance. And all three of those things drive risk. And that's really important, because if, for example, you have an asset that is, and most intangible assets, for example, they're not on the balance sheet. By definition, they're not on the fixed asset register. They're not typically captured in P&L. And most of the time, they're not on the risk register either. So from a corporate perspective, it doesn't exist. And yet, these are the most valuable assets inside most businesses, right? So this is a real problem. So the result of this, what I would call corporate schizophrenia, right? You have super valuable assets on the one hand, and they are largely absent from company financial reports, and therefore the way that the company thinks about itself. On the other, is that you find most C-suites, most boards, most advisors, etc., do not understand, number one, what intangible assets they actually even own. And that's really, really problematic. We don't even understand what assets are. Number two, risks. And obviously, we're going to double click on risk a little bit later on. But it's worthwhile noting that the risks around tangible are very different than they are around physical assets. So every asset has risks associated with it, right? So if you own a house, it can burn down. If you own a car, it can be stolen. Well, intangibles, software, data, code, trade secrets, they all have risks associated with them. Well, but the risks are very different than you would expect. So I'll give you an example. You know, if you look at an office block, what you'll find is that it will be insured for fire, because people have seen office blocks burn down. So we recognize that fire is a risk. However, it will not be insured for theft, a large office block. And the reason why is because it's too big to physically steal, and people understand that people can't steal very large buildings, right? But consider something like software. Software is invulnerable to fire, but it's highly vulnerable to theft. In other words, the risks to software are completely 180 degrees opposite what you would expect by looking at the physical world. And that's problematic, because humans tend to evaluate risk by our interactions with the physical world. And intangibles don't behave the same way at all. The third thing that is problematic is that many companies can't understand how intangibles impact their financial results, right? So simple example, I can go into market in, say, Thailand and buy a t-shirt for $2. If I sew on a Prada label, that t-shirt is something worth $100. If we think about how that's going to show inside the P&L, it's going to be revenue, $100, cost of goods sold, $2, gross profit, $98. Now, we intuitively understand that the brand, Prada brand, created that $98. But in even a simple P&L, that connection will quickly get severed. So a lot of companies can't actually even tell you what assets are actually driving their margins. And it stands to reason that if you don't understand what you are, you don't understand what the risks of those assets are, and you don't understand how they impact on financial results, then how do you unlock value? And that's really what I'm going to spend a little bit of time talking about now, and I'm going to increasingly drill down onto digital, because what you find is that many of what we call intangible assets have a very substantial digital character. Okay, so digital assets, how can they create value? So a way to think about this is that if 87% of assets in your business are now intangible, or likely higher still, if you're the CEO and you want to improve performance, which assets are really going to move the needle, right? And you think about, okay, am I going to lean on the 13% of the tangible, or am I going to lean on the 87% that are intangible, right? If you're an investor and you're investing into a company, what are you really deploying capital into? Right? Are you putting it into fixed assets, or are you putting it into intangibles? If you're a bank and you're lending money, what are you really securing it against? The big irony, of course, is that 85% of all business lending in New Zealand is secured against family home. Highly ironic, right? Given that all value somewhere else, right? And if you're looking at the risks to the company, what are the real risks the company is exposed to, right? So John Maynard Keynes said that concentrate thy risk, concentrate thy mind. And yet that's actually not what's going on right now. Most companies are not concentrating their mind on the right risks. So when you buy a house, for example, the first thing that will happen is you'll get insurance. And in fact, you won't get more without insurance. And the reason is quite obvious. It's most people's largest asset. So therefore, represents a concentration of risk. So therefore, we go and transfer that risk onto somebody else, right? Well, in most businesses, their most valuable assets are intangible. And yet, most businesses don't understand the risk to those intangibles at all. They will focus very extensively on stopping people from stealing stuff like the boardroom table and a company car, but have very little thought about the fact that actually where the risk is concentrated is in the intangibles, but they don't really address that. So what we saw before is that intangibles represent a whole lot of different types. And the ones that I've highlighted in yellow here have a definitive digital character, right? And that they have, what you find is that they will frequently have they're either entirely digital in the form of things like data and software, or they'll have a very substantial digital character in terms of things like systems and processes and confidential information, and even things like networks and relationships. So I want to give some examples now of how digital assets have created value above and beyond anything that would have been suggested by the purely financial valuation of them, right? And I'm going to end on risk. So the first one is here. And so here we see an example of how intangibles, and particularly digital intangibles, drove an exit value for a business. So our client in this case was selling the business, and they employed an investment bank to do the transaction. And the investment bank did the classic sort of EBITDA style multiplier to value the business and valued it at roughly 4 times EBIT. And they approached us, and the client was unsatisfied with this, and they approached us and they said, well, what do you think we're worth? And we looked at what they're doing and went, well, hold on, your most valuable asset is your data. And it was quite clear it was the most valuable asset, but it was off the balance sheet and nobody was talking about it in the sales process. And so we took over that sales process and we did two things very differently. Number one, we really talked about data, and we talked about why the data was important and valuable. And number two, we targeted people who wanted to buy data, not who wanted to buy an operating business. And the reason why is that those people who wanted to buy data had a much bigger checkbook. And we ended up selling that business for 32 times EBITDA. Now, as anybody who has spent any time in investment banking will tell you, you do not pay 32 times EBITDA for a business on the basis of its financial results alone. Something else was going on. And the something else that was going on in this case was the value of those digital assets. Right? Because the financials would only have suggested a 4 times EBITDA multiplier. This one here is different. So the first case we had an exit. Here we're talking about really intangibles as using as a strategic lever. So our client in this case is entering into a 50-50 JV. JV is valued at 50 million. Each party has to contribute 25 million in cash. The counterparty in this case is a very large US company. Our client, New Zealand company, didn't really have 25 million cash though. And so they came to us and they said, look, we're also contributing these valuable intangibles. Do you think they could be worth something? And those intangibles were data, software, and associated industry know-how. And so we said to them, look, we think they are valuable. Went through a process of valuation, again, identification, rid of risks associated with them, then we valued them. And we said, well, look, we think that they're with us. And we provided that valuation to the counterparty, the large US company. And the US company said, look, we don't buy this. We think that the assets are worth precisely what they're on the balance sheet for, which is $0. And so we said, okay, well, that's fine. If you think the assets are worth $0, well, we just won't put them into the JV because they're clearly valueless. And at that point, we went, oh, no. Actually, hold on, the assets are actually why we want to do the JV in the first place. And so the end result for our client was that instead of needing to put in 25 million in cash, they only needed to put in 3 million in cash. So we saved them 22 million in cash because that 22 million came from a contribution of those digital assets, the data and the software and the associated know-how. It was there, it was just not on the balance sheet. Nobody was thinking about it or recognizing it. So this one here, different scenario again. So here we have assets as a capital raise driver. Right? So here the client has developed this amazing technology around data centers, and it's embodied primarily in software, also data again, and also some supporting confidential information. They needed to raise over 100 million to build this first data center. And they went off to see one of the big four accounting firms and who gave them a $40 million pre-money, which made the raise non-viable. Just it wasn't going to work. They approached us and they said, what do you think for it? And we looked at them and went, oh, okay, we understand the intangibles you've developed. They're super highly, very, very highly valuable. The fact that it didn't cost you a lot to develop doesn't mean they're not valuable. So we think you're actually worth closer to $200 million pre-money. It would be fair to say the big four accounting firm did not agree with us. Right? However, our client took the valuation to JP Morgan in New York, who said, we love this, and they went out and they raised 400 million in equity and 750 million in debt at that 200 million money. And they've subsequently, in Q4 last year, exited for 3.2 billion. The value was there. The assets are very real, right? They're just not tangible. And the mere fact that they're not tangible doesn't mean that they don't have a very substantial value and that they're therefore not subject to very substantial risk as well. And I'm going to talk a little bit more about a couple of other ones, and then I'm going to talk specifically about the risks to these assets, right? But we wouldn't have the conversation about risk unless there was value associated with it. So this is a very famous cover associated that the Economist put out a couple of years ago, talking about the value of data and how the fact that data was now more valuable than the world's oil, and they're almost entirely correct, particularly as now you're basically paying to put oil back in the ground. And it was a really famous case involving Caesar's Palace, and Caesar's Palace went into bankruptcy post the GFC. And one of the hedge funds that was involved in the transaction took control of this otherwise ignored asset, which was 30 years worth of gambling data. And it was not recorded on the balance sheet again. Another digital asset didn't make the balance sheet. And the question was, well, the creditors, the question becomes, well, how much is the data worth? And long story short, the data ended up being valued at $1 billion. In fact, it was the highest value asset in the entire group. The last one, last case I want to finish on this, you don't see any of these around these days, do you? Qantas, you might recall, in the late 2000s almost goes bankrupt, and hopefully it doesn't go again. And in a bit of a Hail Mary, Qantas makes a decision to monetize its data, and because it had an enormous collection of data, about 80% of all Australians were members of Qantas Club. And so it starts to monetize its data, and it's extremely successful at it. And the research that we compiled indicated that Qantas was making 6 times the margin selling data than it was paying people around the world. And in fact, the data business was growing at 7 times the speed of the underlying business. Right? And in fact, in some years, you can see here is the data, the loyalty program business, which was in blue here, its contribution to underlying EBIT exceeded the entire rest of the group in many years between 2008 and 2014. In fact, what we find on this graph is that in many years, data ended up being worth more than the rest of the airline. Right? And Goldman Sachs did a separate study on this and confirmed these results that, in fact, data was about half the value of the airline in short over this period. Half the value of the airline is in data. And an interesting sort of correlation, 10 years later, what we find is that just about 6 weeks ago, United Airlines, facing COVID damage, havoc wreaked on the industry by COVID, tries to raise capital to support itself. And nobody is interested in the physical assets. Nobody wants to buy leases on aircraft, etc. But there was an asset that it monetized, and it was its data. And Goldman Sachs secured a $20 billion securitization against the frequent flyer loyalty program. Right? So these things are very, very valuable, I guess, is the key point that I want to make. But most of the time, if you're looking for them in the financial accounts, you're going to come up empty-handed. You need to look in other places. You need to understand that these digital assets are very real, they're very valuable, but they're not going to be correctly reported in financials. So risk, right? You couldn't have a presentation of rooms without talking about risk. So what risks, in fact, do we need to manage around these intangible assets? So I know this is a hackneyed theme, but honestly, I've never thought of a better one. If anybody's got a suggestion on a better theme for this, though, I'd really be interested to know. But if 87% of company value is intangible, well, where is the risk, right? We know that these are the kind of tangible assets that companies deal with, but when you start thinking about all of those different intangibles, we actually start to recognize that there's really serious value here and that most companies aren't looking at it at all. And over 1,000 client engagements, what we found that the same 5 risks just keep coming up again and again and again when it comes to intangible assets. And these are the ones I'm going to quickly talk to now. The first is most companies leak like a sieve, right? Most companies are constantly leaking valuable, confidential information and intangible assets, right? And the 3 ways they typically go out are customers, suppliers, employees. And I know that it's not popular to say this to anybody selling cyber insurance, but you're vastly more likely to have your valuable intangible assets leak out through one of these routes than a Russian hacker hack you, right? Fundamentally. And I'll give you an example of this going on. This is a case that's quite dear to my heart because this is NAV, right? And so NAVman at the time, when I was employed, we were growing like a weed. I was employee 316 and we grew to 900 staff within 18 months. So as part of the SMT. And we could not keep up with demand for our products and services. And we could not hire engineers quick enough. And we had to deliver a particular product and we couldn't do it, simply weren't able to do it. And so we found this automotive software engineering firm in Germany that could help us deliver a product. And so we got these guys to deliver the product and they delivered it on time and on budget. And we thought we were very clever. And so we said to when we had to do version 2 of the product, we said, look, we'll use the Germans again because they were great. And couldn't find them, they'd vanished. And they turned up 6 months later as TomTom with 25 million euros in venture capital in their back pocket. And what we subsequently discovered is what had happened is that one of the medium level engineers had copied our entire software code base onto a CD in the days when you still FedEx code around the world on a CD and had sent it to them. And although you might think that's insane, but actually, if you think about it, it's not so stupid, right? Think about the thought process. It's not on the balance sheet. It's not on the fixed asset register because it's not a fixed asset. It's not captured inside the P&L and it wasn't listed on the risk register at all either. And so we sent our most valuable asset, which was tens of thousands of engineering hours of time, engineering, time and effort to another party with basically no controls over it. The result was, of course, it got taken from us and it cost NavMan about $150 million. That's direct cost roughly, right? Because they outcompeted us completely in Europe. Next risk. About 8 to 10 companies we see cannot prove they even own their intangible assets. And this is particularly critical with digital assets. Right? And what you find is that unlike tangible assets, intangible assets are very hard to inventory. Typically, they don't have a physical presence, they're not registered, they don't appear in the balance sheet or the P&L. And so when you start getting involved with joint R&D or contractors or supply agreements or employment disputes or restructures, they all lead to what we call chain of title issues. So I'll give you an example of this. So this is a very high growth fintech company that we're working with. It's raising a $36 million Series C at a US $120 million pre-money. And the investment, any investment documentation that you go with when you're investing into a company or buying or selling a company is going to include a standard warranty. That warranty is going to say you own all the assets. It's absolutely bog standard. Right? And the investors in this case did to the software company, and they couldn't. And when you actually really boil it down, it became obvious why. One, there had been 3 founders, and they had worked for a year unincorporated, and then one of them left. So straight away, you have a split in the code. Right? And then they employed various friends and family and contractors and so forth. None of them had been documented properly. Some hadn't been paid properly. Some were paid in Mountain Dew. It was a bit of a mess, right? And then they merged with another company. And then the whole way through the process, they're using a whole lot of open source code, which I'll talk to in just a moment. And so you end up with this Gordian knot of code, and nobody could establish who the hell owned what. And so the investors not unfair, well, why should I give you $36 million if you can't even prove you own your core assets, digital assets, very valuable digital assets that you don't know, you can't even prove who they are, right? The irony is, of course, they could prove who owns the paper. Excuse me. The third key risk, software ate the world, right? And 80% of all software code now is open source code. And the issue with open source code is it presents three very serious risks. Nothing wrong with open source code, by the way, but it does present three serious risks. Number one, who owns the code? If the open source code you got off the internet was written by some guy in his basement in Romania, do you really own the code, right? And if it's 80% of your code base, do you really own your code base? Number two, it is a very common way of getting malicious code inside an organization, right? You build a benevolent looking piece of code, put it under a nice looking license terms, somebody plugs it into their code base, and all of a sudden you've got malicious code inside your code base. Number three, a lot of open source code can end up distributed under very toxic license terms. And so some of the fixes that those licenses, for example, is that if you plug open source code into your product code, all of a sudden all of your production code becomes open source code, which means you might have to, for example, distribute it for free or make the source code available, which you probably don't want to. So here's an example of this going on. This was a private equity firm that had committed to invest in a very high growth industrial company, stainless and stuff, as you can see here. But when you really dug the surface, you find out the real assets. It's not much like my other example before. Conventional due diligence conducted by extremely expensive Sydney lawyers detected no material risks. We got involved and looked at what they're doing and arranged an audit of the software code. And what we found was extensive use of open source code software. There were substantial cyber licensing issues, cyber liability issues, licensing issues, chain of title issues, etc. And this wasn't a small investment. This was $100 million. Imagine buying a building for $100 million and forgetting to do any kind of engineering, fitness regulatory checks. You'd be fired. And yeah, that's what happened here. Core asset of the business, software, digital asset, nobody thought about it. Nobody thought about the risks. Risk number four, about half the companies we see do not own their brand or have major brand risks, right? Brand is oftentimes a company's most valuable asset, and yet poor trademark strategy or change in market or product geographic coverage lead to no or poor protection. Most companies understand their brands, they don't understand trademark law. And the advice that gets given in this space is actually very weak. So, for example, most companies don't understand the difference between a device mark and a word mark, and yet they're fundamentally quite different things. And unfortunately, trademarks, like real estate, the best sites are normally owned by somebody else. And so if you lose your mark or your access mark is restricted, etc., it's really problematic. And so here I give you an example of this. This was a company we work with, very fast-growing company. They're investing about $1.5 million a month building their brand and their customer base. And they're planning to leverage that brand into an offshore market. And we sat down with them and we said, is this your brand? And they said, yeah. And we said, well, okay, so there's no news here because you only have a device mark. You don't have a word mark. And that's massively less powerful than the word mark. But the worst news is actually the word mark is owned by your competitor in the market you're planning to expand into. In other words, you can't use this brand where you're planning to expand to. And that was really problematic because they'd spent $36 million building that brand. $36 million had gone to waste completely because they didn't understand that this was a very valuable asset and they hadn't managed the risks of it. The final one is this, is that freedom to operate risk or threatened or actual IP litigation. What you're seeing is that as more and more companies have begun to understand that intangibles are extremely valuable, there has been this enormous growth in litigation over the last decade. And in essence, if you become successful, you're going to get sued. That's the way to think about it, especially if you operate in certain markets, particularly the US market. The consequences of, once you get to a certain scale and size, you just get sued the whole time. For example, when we were working at Navman, when we got acquired in Brunswick, we got sued 3 times in 4 weeks for various kinds of IP infringement immediately following the acquisition. and been sued for 16 years prior to that. Consequences of that kind of thing are injunctions, product seizure or recall, massive litigations, damages, etc. So here's an example of this going on. So this is an award-winning New Zealand hardware company. They made a series of mistakes. The first is they never analysed their intangible asset risk or developed their own intangible asset shield. So they never really got to grips with the whole concept of what their intangibles were, or tried to develop their own in a material way to ward off competition. Secondly, some professional, I'm going to put that in inverted commas, VC firms invested into the business, and the extent of the due diligence on the intangibles or the IP does have a patent, yes or no. Right? That's not IP due diligence. The third thing that went wrong is they went to a very expensive short and sweet lawyer who allowed them to sign off on a supply agreement which they had agreed with a very large US company, a Fortune 100 company, and they indemnified that Fortune 100 company for any and all IP infringement. Think about it. They have no understanding what their intangibles are. And they've done no due diligence going into this, and they've just massively magnified their risk by indemnifying a much larger company. And the inevitable happens, of course, an offshore competitor figures out what's going on and sues the customer, and the customer calls on the indemnity, and so the competitor comes down to New Zealand and said, look, we're going to sue you out of existence, or we can acquire you. And so they acquired them for roughly a third of their value, creating approximately $100 million loss to the investors. All related to intangible assets, the digital assets that were the heart of the business, and yet nobody recognized the value. Nobody recognized the risk, therefore, as well. I want to talk just a little bit about cyber, because this is a topic that, and look, cyber is very, very relevant, but it is a topic that I think sometimes almost ends up being a substitute for discussion around intangibles. In other words, people think, well, I've covered off cyber, so I've got the rest of my intangible asset risk covered. Not so. So you really want to distinguish cybersecurity ultimately, and therefore also insurance, is primarily actually about the perimeter. Right? It's about stopping people from getting into your castle or letting you know people have broken into your castle. It's not about covering the contents at all. Intangible asset risk is defining what the threats are and the targets. What are the targets? What are people after, actually? So another way of thinking about it is that typically, your classic cybersecurity is dealing with unknowns, external threats. Those are the people who break a window, hack into your system, hackers, industrial espionage, etc. That's what cybersecurity fundamentally is addressing most of the time when most people think about cybersecurity, right? But there's actually two other significant threats. There's knowns. These are semi-external threats. These are people who would say have a key. So those are contractors and suppliers and partners and so forth. Those are people who are already known to the business, who have access to it, and will therefore have access to a lot of valuable intangible assets, typically data, content, software, confidential information, etc. They come in through your front door, or they have a key, right? But actually, the biggest threat is your well-knowns. They're an internal threat. They're the people who live in your house, right? Those are your employees, your directors, etc. They are the folk who typically end up leaking huge amounts of valuable confidential information, or leaving job, looking out with a thumb drive, etc. Those people are actually your greatest source of threat in many cases with respect to intangibles. So the thing you really want to understand is that although the Russian hacker who creates a fake invoice, etc., and defrauds people, gets a lot of attention, the real prize is not actually your cash. The real prize is actually your valuable intangible assets. That's actually what this really serious people are after. And that's what state actors go after. It's what really serious corporate espionage is after. It's not cash. Cash is obvious. It's actually the intangible assets. So summary, what do you do now? Like, what's the response to all this? It's not this. Right, you can't unring the bell. Now that you've heard this, you can't go back to this stage, right? What should companies do? Well, the first is ensure that you've identified what your core intangible assets actually are. If you can't do that, then you can't do anything else, because those assets are absolutely critical and essential, and you need to understand what they are in order to manage the risks of them. If you don't know what they are, you can't manage the risk. You need to have an independent strategy to protect and manage and to exploit those assets. Number 3, you need to have identified what the risks to those assets are. And number 4, you need to have a clear strategy to manage and mitigate these risks. And if you don't believe anything about the value side of what I've talked about today, I'll give you an additional motivation for dealing with this. Directors and officers under company law have a fiduciary obligation to manage all assets and risks to those assets under their stewardship and control, including intangibles. The mere fact they are intangible does not mean you can, it obliviates your responsibility towards them. So these things do need to turn up on risk registers. They do need to be managed as a standing place. So in summary, what you find over the last 40 years, there's been this massive migration of value and risk that's occurred. It's not typically reflected in the accounts, however, so the accounts are not going to capture the stuff. It is now the primary drivers of virtually all company performance and therefore also risk. And finally, this is a trend that is not going back, right? This is not like a pendulum where it's going to swing back in the other direction, or suddenly the economy is going to get much more about bricks and mortar and physical things. The arrow is only pointing in one direction. This is all baked into cake. It's all about intangibles from now on. So we're going to find this going to become more, not less important over time. So hopefully that has been useful, and I've left some time for some questions, and very happy to take those. And I'm going to stop sharing my screen at this point.
Great, okay. Thanks so much, Paul. So we've got a few questions that have come through, so I'll just fire them at you.
Sure.
See how quickly you can think on your feet. So what are the top 3 things you think risk managers should do to help their companies better manage their intangibles?
Number 1, you need to identify what they are, right? So you cannot start that process without having identified what the intangible assets are, because otherwise you're just dealing with an amorphous thing. It's just a massive big concept. So first thing is, what actually are your valuable intangible assets? Number 2, then you need to start figuring out what threats to them are, and that's going to help you to define the risks. So to actually say, well, if this piece of software is extremely valuable to us, what are the threats to it? Does it get exposure to the outside world? Who else has access to it? How could it potentially be lost or transferred, etc. Right? So you'll be able to unpack a series of risks around it. The third is education. Right? You have to get this into the C-suite, into the board, to get them to actually do something about it. And what I can tell you is that this topic is always important, and it's never urgent. Until something goes wrong, then there's a crisis, and all sorts of hell breaks loose. And at that point, people are, the finger pointing starts. But you really want to get in front of it, and you have to educate. You have to go to the C-suite. You have to go to the board. You have to get them to recognize this is the heart of the business. If you care about the boardroom table, you're caring about the wrong thing, right? It's going to be in your intangibles. Unless you're pure real estate, it is going to be in your intangibles. So.
I suppose getting the attention from the C-suite is really driven by the identification of the assets themselves and the threats/value. And then if you package that with highlighting the fiduciary obligation the directors have, hopefully that's enough to get them engaged.
Yes, yeah, absolutely. Yeah. So and that's why I mentioned the fiduciary obligation, is that nothing motivates a director like the prospect of potentially being on the end of a D&O suit, right? So it's important to talk about that, and it's real. It is legitimate, right? Most directors, they're trying to do a good job. They are trying to manage those assets as effectively as they can. It's just that the accounts lead them to focus on the wrong things. As I said, language is powerful. And so you actually do want the way around that is, and what I think the role of many of the chief risk officers and risk professionals is to get the directors and the board and the C-suite to think beyond the physical assets and start thinking about the intangibles.
Great, thank you. And there's two questions here about the valuation of intangibles, which sort of dovetail. So I'll ask them together. One of the underlying causes for the blind spot on intangibles is how value is defined. So do you see any big changes on the horizon for redefining value to include intangibles? And also, is the valuation of intangibles too subjective and the variable or the variance between value is difficult to audit and verify?
Yeah. Okay. So, yep. Good questions. First of all, I'll deal with the first one. Do I see any changes coming up in the accounting standards? No. I would be very surprised if they change any time in the next decade. And the reason why is because those accounting standards evolve at an extraordinarily slow rate. And they have huge implications for industry and tax and a whole lot of other things. So I don't see any changes happening. So there's also a whole lot of built-in incentives that or status quo situations that would discourage changes to those accounting standards. So I don't see those changing anytime.
Do you think, sorry to interrupt, do you think that's even the case when we have some changes around like climate change risk reporting? Because that's not an intangible asset depending on your business, but it is an intangible risk.
I think that you might have change. I mean, something like climate change that may come through. There might be changes in standards and reporting, etc. But what I'm talking about goes to the heart of how our economic system is organized, right? So I'll give you a really simple example. When companies do R&D, generally they will expense it. Sometimes they'll capitalize it, but most of the time they'll expense it. In the case of, or as a consequence of expensing it, they increase their expenses, which reduces, if they're profitable, their tax burden. So if you suddenly require companies to, for example, place those as intangible assets on their balance sheet, it's going to change their tax requirements. So there's a whole lot of it's like if you suddenly change the English language, right? The implications will radiate out. It's really fundamental, and that's what's going on here. So I don't see it changing anytime soon, unfortunately. In answer to the second question, you're absolutely right. Yeah, it is difficult it's more difficult to value intangibles than it is a typical tangible asset. There's two reasons for that. Number one, tangible assets typically have this really defined relationship between cost and value. So we can figure out what certain things are going to be worth much more easily. The second is that the markets for tangible assets are typically well established. They're very liquid and they have very, very efficient price setting mechanisms. So, my car, I can go on to Trade Me straight away and find out within a couple of $1,000s what it's worth, right? Because you've got these very efficient markets with very efficient price setting mechanisms. That's not the case with intangibles, but it will slowly get there. If we went back 150 years, then you would have found those markets were nowhere near as efficient at setting those prices, right? It takes time for the processes, the systems, the data, etc., to build up, for people to start to develop methodologies that are more reliable and more effective. Many of the mechanisms that we use for valuing companies today, Standard & Poor's, PE ratios, Sharpe ratios, a whole lot of other things, they didn't exist even 30 or 40 years ago. Standard & Poor's goes back to, I think, 1870, but they didn't exist very long ago, right? So we've had to develop these mechanisms to enable us to more effectively value companies and assets and so forth. The same thing's going on right now for intangibles. So if you went back a decade, our ability to value intangibles was much worse than it is today. In another decade, we will be that much further ahead still. The thing that's going to help us, there's this enormous tailwind that's pushing behind because they're now so valuable. So that is going to change.
I suppose that's always the case when you're on the crest of the wave. You just can work within the information, finance, markets, parameters as they exist, and every year, every decade it improves.
Yeah, exactly. Precisely. And that's the thing. If you fast forward 20 years, it will be very normal to be doing, and you'll be able to say the value of these things quite effectively. Yeah, but in much the same way as that you would have struggled to value certain intangibles not long ago, but certain tangible assets not too long ago. But it's just a process. It's an evolutionary process, and we're getting better and better at it, and it's more and more robust. And what's surprising is you can value just about anything, right? It is. We've been asked to value some very weird things. You know, we had to be asked to value 30 years worth of brain scan data, right? How do you do that? There was no P&L associated with it. There's no revenue associated with it. What was it worth, right? Well, we managed to figure it out.
Interesting. So from riding the wave into the future of intangibles, and you spoke about the mismatch between risk identification and risk financing or insurance. What do you see in the insurance industry for policies responding to digital or intangible asset loss? If there's an absence of product in the market, should companies be trying to figure out how to self-insure?
So yeah, you're right. This is a big gap right now in the insurance industry, like a very big gap. If you really think about it, sort of pre-1950, insurance was fundamentally aimed at physical assets, and then we got into liability, and it was a big sort of growth in liability. The next big cab off the rank is going to be intangibles, right? And it must be. And the reason why is it's so much of the value of the economy. How could it not be, right? But insurance companies are probably the only thing on earth that's more conservative than banks. And so, it takes time, it takes time. So they have had some false starts as well. A couple of the companies have come out and tried to do IP, particularly specific IP policies, like, insuring patents and things, which was a bit wrong-footed. People are trying in this area. For example, I think it's Aon appointed a chief IP officer recently. Their Lloyd's of London has started talking around intangible assets. So it's getting there. But for the moment, what you'll find is that most of the products in this space aren't very effective, or they're really expensive, or they're both, right? And so therefore, most companies are going to have to self-insure for a lot of these risks in the meantime, because the ability to transfer them is quite limited, except in the case of very bespoke policies. So cyber only goes so far. And that's a really important point. People should understand cyber is not the same thing as intangible asset risk or insurance. It is a very small subset.
Yeah, and one of the a company I used to work with was launching a reputation protect policy to address at least the company's goodwill from a customer and market relationship perspective. And that was a really difficult product to price, sell, explain, to get other boards and customers to sort of see the value in having. It was predominantly a crisis product, but to have see that there was value in a new insurance product when they're mostly geared towards like NDBI losses.
Yeah, and one of the solutions that companies are starting to look at all is parametric cover, right? Which then can give you an ability to kind of draw some delineation around the extent of the issue. But you guarantee, you go roll forward 10 years, this is not going to be a weird conversation.
No.
Yeah.
So there's a couple more questions. Most companies have on their risk registers mitigations to protect data, for example, confidentiality, privacy policies, IT and cyber related policies. Do you mean that if a company does not know how to value that data, if it is lost, it's meaningless?
No, it's not to say that if you can't value it, it's meaningless. It just, it tends to, in the absence of evaluation, it tends to make it much more difficult for the company to drive the right behaviors.
So I think that's what the question is getting at. So if we don't know how to value the intangibles that these policies are seeking to protect, are the policies themselves pointless?
It depends what the policy is trying to cover. So if the policy, if the classic cyber policy will generally try to put you back into the position that you were prior to the event. So if you've, if you had to pay a ransom, you recover your ransom. If you're down, if you've got business, essentially it's business interruption. If your systems go offline, it'll put you back. But the issue becomes what happens if they steal a core trade secret, right? And they put it on the internet. Then you've got a real problem. Right, and that's oftentimes much more damaging actually than somebody hacking your system for 3 days, right? So if you enjoy a 10% margin advantage relative to your competitors, and that adds up to your $10 million company, that adds to $1 million a year, and that gets hacked and gets put onto the internet, that's really damaging, right? But how do you value that? And that's one of the issues, right? That's one of the issues that the insurance industry is really grappling with right now. It is possible to value it, but if the customer won't value it, then you can sure as eggs guarantee the insurance company's not going to.
What I think you touched on this a bit earlier, but and parametrics is a good example of that. There's typically bespoke cover available for nearly every risk that you can identify and that you can value, but the cost of obtaining that cover seems prohibitive. 10% of a $10 million company value, you can find $1 million worth of cover. But if you're talking about Amazon's trade secrets available on the darknet or whatever, there is no insurance in the world that could pay out that claim.
Yeah, you're absolutely right, and that's the issue. That there's a lot of friction in the system right now that people don't really know how to identify. They don't really know how to run lines around the risks. There's an absence of actuarial data. People don't know how to value the stuff, and so it's ended up being tossed into the too hard basket. And 40 years ago, the too hard basket, it kind of didn't really matter, right? It was only 17% of the company value. But when it's 87%, it can't live in the too hard basket anymore. And so therefore, what you're going to find is my prediction is you're going to find more and more customer demand coming on to the insurance companies, forcing them to respond to this. And you are starting to see that now. Yeah.
Okay, so we're running out of time, so I've got 2 quick questions. One's a bit selfish, this is my question, and it's about the ownership of my data and how do I monetize Alana? If I've signed up to 100 different websites and you've got Google, Facebook, Amazon making money off me, do you think that there's going to be a shift towards, I don't know what the model would be, a subscription model where I can at least obtain the benefit short of buying shares in Amazon of me?
Yep. So what you're talking about is something called data sovereignty. And long story short, look, you're the product, okay? And in the sense of, when you deal with somebody like Facebook and Google, the fact that stuff is free is because they're taking something from you, and it's your data, right? I predict will eventually you'll see the rise and development of services where you have control over your data, but you'll probably also end up paying for those services at the same time, because what's the business model, right? The business model has to be, somebody's got to be making money somewhere, right, along the line. And so that means the sort of substitution of you giving it away you getting it for free will have to be, well, if I don't get it for free and I own my data, then I'm going to have to pay for it. Now, maybe then you'll find the development of business models that aggregate your data and you can allow them to use it on certain bases, but there has to be a business model that works. Right now, we're in the business model where everybody's basically sacrificed privacy for convenience and $0. Like that's what you do when you deal with Facebook or Google. You sacrifice privacy, in return you get a product for free. And that eventually that dialectic's going to shift. It's going to take time. Yeah.
Great, thanks. And the last question is COVID-19. So do you think that this year has changed how companies think about intangible assets value, the importance of them? Should companies be thinking differently post COVID-19, or potentially living with COVID-19 for a while, about how they identify, value, deploy, protect their intangibles?
Yeah, what I think COVID's done is basically it's rammed 5 years worth of technological evolution evolution in consumer behavior into 1 year, basically, or 6 months, right? I mean, the fact we're here, right? Normally, I would have traveled to wherever you guys are. I would have given a presentation in person. There would have been some wines and canapes. And look, we're all here on a webinar, right? So certain behaviors have changed very fast. I think that's basically seen a huge shift onto digital, and that's just going to keep going, right? And when you shift into digital, you become intangible, and so that's really the story. You go digital, you go intangible, and a lot of companies know they've gone digital, but they don't know they've gone intangible.
Okay, cool. Well, thank you very much. Thank you, Paul Adams, the CEO of EverEdge Global, for joining us today. Thank you for everyone who has dialed in. As promised at the top, we will circulate a recording of today's session, a copy of Paul's slide pack. And if you have any other questions that we didn't get to today, or something that occurs to you at 2 a.m. in the morning, please shoot them through, and we will follow up with answers to those additional questions in email.
Perfect. All right, cool. All right, thank you all. Thank you very much, and much appreciated. And thank you, Alana, for your great hosting. And what was the dog's name?
Oh, her name's Artemis. She got right to the end before she made an appearance. But
all right, cool. All right, perfect. Thanks very much.
Thanks very much, Paul.
See ya. Bye.